Are we as investors and traders witnessing a dot-com bubble crash? With $500 billion being wiped off Nvidia in less than a few sessions, it has everybody asking that question. But in today's video, we uncover what the options market and the biggest dark pool liquidity has really been telling us, and why it seems like the market has gone back to a rule book that it's used several times since the 2022 bull market started again. Let's break down stocks, commodities, and cryptos, including some of the most important charts that all of us as investors and traders need to be watching right now. Well, welcome back everybody to The Daily Show. My name's Tom, and today, of course, we've got to be discussing what's going on in semiconductors and the rotation that we already started to see just a few sessions ago. If it's your first time here, remember to subscribe and smash that like button and bell icon if you want to understand more about how Wall Street flows start to occur, and more importantly, understanding dark pool activity and the biggest price action levels. So let's begin today's video by discussing a very key metric. No 2% drops on the S&P 500 for over 330 days. And this puts us into fairly rare company. In fact, we haven't really seen this happen since the 2017-18 run. And it really hasn't happened before that since the massive run of before the global financial crisis. Now, why could this be about to change very, very soon? Well, a lot of it has to do with election years. And if you know your stats, you'll know that volatility from this point on, basically into July, all the way through to November, tends to spike up. And this means that the VIX usually does start to rise. Now, this great chart here shared from Mike Zaccardi over on X really shows you overall what tends to happen. And after the election, how much volatility tends to drop off. And of course, markets usually do turn to the bullish end. Now, why this is going to be important is not because we want to be trading the VIX, but as day traders, as investors, and as everybody else, this gives us a chance of some opportunity. And it means that many markets will probably start to move in larger ranges, both on the bear side and the bull side. And in particular, that means that you may be able to have larger take profits, and more importantly, maybe sometimes just more opportunities. So why could this be coming already? Well, a lot of it has to do with these sentiment surveys. And as we reported in our recent sentiment surveys, pretty much dictating that we thought 5,500 might be a temporary top, is because we started to see bears absolutely dissipate across the board. And while the longer term trends, as we'll look at later on, still remain quite bullish, it had us thinking, well, maybe there's a little bit too many calls in particularly the semiconductors, and it may be time for Wall Street to start taking some of those profits. And of course, that does seem to be what they're doing right now, which we'll look at soon. But as we know, it's really better to look at the bull-bear overall spread. And you'll notice that we've hit back to where we were just before the sell-off that happened into, of course, that April period. So will we see a bit more of a sell-off? Well, that depends on some of the areas that we're about to possibly see broken. And we'll look at the S&P 500 as our guide soon. But one thing's for sure, Nvidia just copped a massive sell-off. And a big reason why that is too many calls. Take a look at this chart. The rest of the S&P 500 is barely getting that many calls on it, according to this chart here, again, shared on Isabella.net. And you'll notice it sees here a huge uptick across the board from the mega caps and tech. And this probably is a mixture of huge funds starting to get involved in it, but also retail traders like you and I starting to really get that FOMO in and starting to think, well, Nvidia's never going to stop. And that has happened a few times. Remember, when we look at our Nvidia in a moment, and I'll talk to you guys about it, it does tend to do this. It tends to FOMO up, consolidate down, go into kind of like bearish style corrections, and then often it will pick back up. And so let's have a look at why, again, this could be. And a lot of it, I think, has got to do with these big transactions we discussed the other day. Here's a huge transaction that came through on the S&P 500. You'll notice the other large transactions were down near the dip of April. Of course, another big one just before we started selling and around when we started selling. Now, we already detailed that we saw a massive transaction go through on Nvidia into OPEX, and we saw a massive transactions going through on Broadcom as well, which are both led into further selling throughout the Monday session. Now, when we have a look at seasonality, it also makes sense. And while this chart, of course, is just semiconductors, it doesn't actually follow necessarily exactly what happened this year. You will notice that if you're going to see weakness in semiconductors, you tend to see the most amount of weakness anywhere between that July period and, of course, somewhere around that September period. So does it make sense to see this kind of consolidation in semiconductors right now? Yes, it does. And often the earnings from this period that goes through September into October really drives that next level for semiconductors. So it could be a very interesting time actually for people to possibly get a little bit cheaper price in what I still think, and I think a lot of you out there still think, we all do, I guess, could be still a bullish running event. And you might say, well, maybe Nvidia's hit its high. Well, maybe not, and I'll talk to you guys about that in a moment. Now, let's have a look here at 59.5%. We're starting to see people maybe cooling a little bit on what the percentages were for an interest rate cut. Now, basically, everyone went straight to interest rate cut. The market was pretty much pricing it in 70 plus 80% chance after the recent inflation numbers. Now that's starting to cool off and around 10% swing back towards a no cut in September. Here's a chart I shared over on X. Follow us in the links in the description down below, guys. And I think this is a really good chart of just showing what's at stake here for Nvidia. So 3 days down, correction territory straight away, 15% pretty much sold off. And we enter into a potential temporary bull zone this week. Now, I've highlighted over here, and we'll look at it later along with some of the other weeks moving forward, that puts are coming in thick and fast from some massive traders. And in particular, this 120, which we're actually trading underneath it at the time of this recording, is very important for this options expiration. You can see here for the 28th. Now, we are in negative gamma territory, so if it holds underneath 120, guess what's going to happen? A possible cascade event. And I think the next two big zones are going to be 110-ish. And then, of course, really, if it keeps falling after that, it's even possible to get into those sub 100 categories, which for a lot of people would be a pretty sweet buying zone. And we'll go through the reasons in a moment. Now, for now, though, we've just hit the daily 20 moving average. We've hit a 38.2 fib retracement kind of level off some of the pulls that have happened recently. And of course, we're back into that structural zone where we saw some big traders come through. But for me, it's going to be holding the 120 with price action that may give us something like this. And I think this becomes the kind of more likely thing to start to occur over the next couple of months. A consolidation that the markets have done before. And we've talked about this several times. Semiconductors leads, breadth gets horrible. Then the market rotates, which it certainly has done in the last couple of sessions, and then we might see semiconductors start to pick up again. So let's just quickly talk through some of the facts here that we used to kind of bring that consensus together. The first one here I posted on X is that everybody, of course, is talking about Cisco and Intel back in the dot-com boom of the 1990s. What did we see? Well, we saw Cisco, Intel, Cisco in particular, go to like a 70 to 80 forward PE or even PE ratio. Now, at the moment, Nvidia is not quite at those levels. And in fact, Nvidia is trading on pretty much its 5-year average, although, of course, the 5-year average of Ford is really, really high now because it's been doing so well. We also know that Nvidia has been known to be incredibly volatile, and we just saw a stock split. So it makes sense to, after a stock split, for markets to actually go down a decent amount. And we've already noted this. Now, we expected basically T plus 3. So let's call it the split plus 3 days, and then we'd see sell-off. Well, it wasn't too far off that. Basically, we saw the split here. Markets rallied, and then they've dumped after that. So let's call it plus 7 days. And that's because I think what happened was everybody was sharing that stat. Everyone was aware that the markets would usually fall around maybe 2 to 3 days after it, and it wanted to squeeze out that last final amount. And this is the options market, and of course, the sneakiness of Wall Street really going through. The next one I want to mention is, of course, the fact is that we still haven't seen IPOs really coming through in this market. Now, that's important because usually when you have hype in terms of AI, we see more IPOs. Now, I expect those to come through, and I'd be on the lookout. And of course, we are on the lookout together for this, and we are looking for it. Now, we know a lot of angel investing is happening. I want to see those come into the market, and I expect that to start to happen after the election, probably 2025, therefore. And the final one that I think is really important here as we go through is that we've seen a 15% correction. Now, somewhere around 15 and 20, stocks do tend to find some form of base. So I think that's something else we'll look at as we go through Nvidia later on in today's video. So let's break down some market concepts. What's been driving this market since the 22 kind of new bull run? Well, I think it's no surprise that the only things that have beaten the S&P 500 across the board, other than some of the smaller sectors, maybe gold at some points as well, has been, of course, the two majors, the semis, the tech. That's the stuff that's really been pushing it through. Now, as that's no surprise, we also know that therefore, if we look at the S&P 500 tech forward earnings PE ratio, it's starting to hit up there. Now, if you compare it back to the 1990s, it's still not that high. It's still not bubblicious. Now, we're all talking about the bubble in Nvidia, and of course, a few days later it crashes. Then everyone starts to say, okay, it's here. It's unlikely to do that. And that's because, generally speaking, what happens is we see these huge corrections, but we really need incredibly high multiples. And you might say, well, whenever you go into a bubble of any kind, multiples just get extreme. If you want to have a look at this, have a look at the 1980s into 1990s Japan. While it's not maybe the same thing, that was the wildest in terms of overall percentages. And we have to hope that the US market doesn't go near those levels, because if it does, yeah, we're looking at possibly a lost decade plus another lost decade in those cases. Not very good. But here's where the underlying is, and you'll notice that even the underlying of the S&P 500 got pretty wild during the dot-com bubble, and even very wild during the 2020-2021 bubble. So I think forward PE ratios, we're still sitting okay at around 17.8, and we're not quite a standard deviation out. So this is the one I'm watching, and I think right now what we're doing is we're looking for rotation in this market, and the Dow Jones really is showing that. Here's some other examples of how the world markets are and the US market is. The US market is, of course, being driven by supposed earnings increasing, and most of that is coming from a couple of stocks. As we already know, it's these stocks here that are getting revisions to the upside. The S&P 500 is kind of flatlining as best it can, and the S&P 495 is actually getting some downgrades across the board. So most of this is coming from those top-end stocks. In the emerging market world, it's actually kind of, again, even going down to flatlining across the board. And these charts here from Jury and Trimmer, I think, are quite good, because what they're showing us is they're really showing us that, yes, most of these analyst estimates are continuing to kind of point towards slight bullishness in markets, and therefore they're putting that into their targets, therefore buying and increasing their overall odds. Now, one of the reasons why I think this is going to possibly continue is another chart here that says household balances sheets remain stronger than in 2019 across the distribution. Now, this is very important for the US economy, and we've discussed the idea of the American consumer. While I think it's going into pretty much, most people are going into quite a lot of debt, they're taking that debt. And what that's doing is it's driving one of our main factors here, which is XLY versus XLP. We're still seeing the American consumer and consumer spending stocks doing better than you would think. And this is something that we must continue to watch along with home builders as we get into this later stage cycle economy, which is really driven by a concentrated market. In recent Goldman Sachs reports, they're actually coming out and getting really wild and starting to call for possible perfect Goldilocks scenarios to basically push the stock market by the end of the year all the way up into 6,300. Now, I'm not sure about that number, but certainly in these points here seems to be where the consensus from a lot of these banks are. And while we won't want to necessarily take that with a grain of salt, in fact, if I think there's a recession, it's way worse than 4,800. Don't get me wrong. It's going to be much worse than that. It'll be back in the 3,000s if we really do get to those levels. At this point, yeah, this is what's driving the market, this concentration, this AI level. And as we've discussed several times before, it's because we think we're somewhere around in this period here, which basically will have dips. It will have volatility, no doubt, and some big crashes in certain stocks. In particular, I think semiconductors are going to continue to get these wild swings both ways. And this is pretty normal. In fact, if you have a look here at the 1982 to 2000 run, what you might notice is that the market takes a massive hit around this point here, yet V-shape recovers that. And it's kind of normal to get these massive hits. We got a hit around this point, which again, that market did. We get a hit around this point, which funnily enough is pretty much where we're at right now. And then we do expect some kind of extreme volatility event sometime in the future, which could mark kind of the beginning of the end for markets. And I think this is something that a lot of us are going to want to be looking out for. And of course, follow along on the channel if you're interested in that. Some other notable things that have been happening recently have been the large transactions going through on treasuries. It looks like someone is probably accumulating positions again in these. And while we do remain bullish on treasuries, remember it's a time frame thing. And we'll look at that soon. But treasuries have been kind of holding up as much as they can. And in the yields that kind of are slightly going towards maybe a little bit less cuts now, but they're still kind of finding a little bit of risk on. So treasuries here, a couple of large transactions coming through in the last 24 hours. So before we go into Nvidia further, before we go into the semiconductors market, which still is the most important, let's have a look at what's happening in the underlying, because most people are just looking at the NASDAQ and saying, oh, it's crashing, everything's looking bad, even after a couple of sessions. The big thing is, okay, yes, semiconductors and technology are both down, but notice the sectors that were up. In particular, we saw banks. And of course, as we know, if banks and home builders are doing okay, that's not really something we should be necessarily terrified of in a market pullback. In fact, that would usually mean it's an opportunity. Have a look here at the last kind of sessions. Now, we've been talking a lot about oil being in that bull run, and it does look like it is because, of course, energy stocks having a stellar 5-day performance. Again, regional banks holding their lows and XLF also holding its low. So is this a rotation back into metals, which we've seen before? Maybe a new reinflation play as everyone's standards of inflation gone might be starting to get taken away? And is this also a bit of a sign of an underlying overall money flow move? I would say yes. And I think a lot of you in the comments that I read recently were kind of starting to nibble on this because you saw the Dow Jones doing a lot better than the broader market. Now let's have a look at the S&P 500 and go through these charts together. The first one here, of course, is those signs of topping out. And basically what happened was the S&P 500 went to around 5,500. You can see here on the real market, and it found weakness. Now futures got higher than this. But notice this big sell-off over the last 24 hours. Now, this actually usually means there's more bears to come and that rallies will be flushed. So this is a pretty interesting candle. Basically, we have a doji, which is equilibrium, or effectively the market is happy at that level. Then we get a rally, which we expected in the last video, and we get a sell-off. Now, right around that 5,500, 5,490 was exactly where we expected the bears to come back in. So it was actually really nice day trading and scalping over the last 24 hours in the markets, and they managed to push it down and close it on its lows. Now, this suggests that there will be more selling to come, but I'm not sure it's going to happen in the next 24 hours. So let's have a quick look here. And the reason is because we're getting right down to that first level we discussed on our charts. We talked about the 54.30 to kind of where it is here on this put support for Tuesday, the 54.45 zone, being a zone where there might be a temporary buyer. But have a look at this futures market. It literally hits back into the 44.90, perfect level for seeing some weakness, and then the weakness comes straight through, consolidating. So what might happen here is the market might kind of find this temporary rally, and then somewhere in here, maybe find a seller. Now, if it does manage to get back above this level here and not instantly reject, that's a sign that markets would most likely want to continue up. Now, I don't expect that, but it does take a while. It does take a little bit to stop a freight train. So at this stage, I would say there's more selling to come, and the more likely scenario is kind of rally somewhere into here and then fall through the next couple of sessions, and then hopefully actually get into the 5,300s. You might say, well, why do we want to get back into the 5,300s? I think it would be better and healthier for the market to do something like this and then recover back, because that kind of burns time. It also consolidates and it allows for that rotation to occur. And that probably means that something like Nvidia has also been coming out. So we've got plenty of support just coming in here as temporary. Then we have our most traded level sitting at 53.50, which we've maintained for a little while. And these are the expected options move levels. So again, it could be that the top, this is 68% of the time the market will stay within these boundaries according to the options market. So 54.85 is a possible high, though I think somewhere in this structure here is probably where we're going to see some slight weakness. So let's have a look at why the options market also might be suggesting that. And we'll look first at the 25th of June. Now, on this particular one, you can see we've got tons of calls sitting here right around that kind of 54.80-ish zone. And then we've also got a ton of puts sitting right around this level here, which we find ourselves at pretty much trading. Now, why this is important is because we're in negative gamma again. What that means is if the market does end up taking the low and continuing to push down, which will be an important point, then that's going to create, of course, a lot of dealer hedging. And you'll notice that over the next 2 sessions, we're particularly stuck in this zone. When you go and have a look at the next open or the next big major options expiration in July, 5,300 comes up as the put support. But take a look. If this level is breached over the next 2 sessions, expect that to then cause a cascade event. What you'll be looking for is price action to look negative, but at the same time for it to be, the closer it is to the end of the day, the more hedging that would usually have to go on. So yes, certainly a very, very, very important point for markets. Let's move over to what the CTAs are doing. They've moved down a little bit. I'd still call them neutral. NASDAQ also reducing a little bit. And if we have a look at gold, they're still neutral within the zone. And a little bit of an uptick here in Brent. So basically oil starting to see CTA momentum, and we'd like to see this crack a new high. So basically we'd like to see it go past here and start to move up. And if that happens with price action, that's a great sign that energy is really starting to get that momentum, and energy stocks should also be beneficiary of that. Now let's have a look at Nvidia in a little bit more detail through each expiration. Of course, this week 120 is the key. Again, negative gamma situation. So if 120 is taken and held below for a few more trade sessions, it may need hedging off. 115 being and pretty much marking out that kind of 20% correction. Again, 115, 120, 2 levels. I'm particularly looking for that kind of potential dead cat bounce effect on Nvidia. And these are the 2 major levels, I think, with the massive expiration in July. Look at where those puts are. They're all sitting at like 100. So quite a lot lower. So right now, negative gamma, be very careful out there. You don't really have structure in the markets. You've just got kind of like a temporary low that sometimes you might see on the smaller time frame, some form of opportunity. What about Tesla? Well, it remains completely different to Nvidia. And you'll notice here, while we're still pretty much maintaining the idea that there could be some bullish price action from the options side, we really do need this market to get above 185. And that is the most important thing. Get above 185 again, close the daily above that point, close the weekly above that point, and hopefully then we start to see some momentum flow. So Tesla and AMD in some ways looking completely different to the rest of the market. All right, let's jump into the charts now, have a look at the early warning indicators. Again, here's the options market and bonds. It's not really looking too terrifying, so that's good news for people that are looking for that rotation. We look at home builders. They're holding up relatively well. We look at the American consumer versus the staple side. So that's still holding up, a little bit down over the last 24 hours, but still maintaining its base. We also want to look at things like XLF, which you'll notice doesn't look too bad to me, actually trying to break out to make possibly a new high in the future. So again, rotation starting to come through here. You want to look at regional banks. Regional banks, again, starting to see a little bit of an uptick. So that's good. And all of these things kind of come together to show you that what this looks like at the moment is, you know what, there was way too much pushing on Nvidia. We saw the stock split. We know that's great for the forward gains, but we need that pullback to come in because that's what's been happening. And they just pushed it a few more days to, I think, suck a lot of people into FOMOing into that. And I think it's a really good lesson for all of us in FOMO. You know, if you get in, unfortunately, at the wrong point, then you can get hit 15, 20% very, very quickly in a stock that, even if it's massive and it's the biggest stock in the world at one point there, it can still hurt you very badly. So just always remember that. FOMO, fear and greed, these are the things that usually get you in trouble in markets. What about yields? I don't see any changes here yet, so we'll have to get economic news on yields. And treasuries, of course, bucking that and starting to really try to find further strength. Now, if you've got a larger time horizon, as we've talked about several times, we always like down here, and we still maintain that we like that. And I still think that treasuries will end up doing a lot better, but it's not really a trade, it's more of a position. So you'll notice I've got supercritical zone up here. About that 108 area to 110 is an eventual target for me, but it's going to take some time. Treasuries move slowly. They're not always like they were the last couple of years. What about the US dollar? Well, it actually suffered a fall off the 105.50, and although the weekly still remains quite bullish across the board, it's a very strange one. I find this a relatively difficult chart. You might say, well, Tom, it looks so easy. Look at this. It just keeps buying and buying and buying. Yeah, I think at this stage, the chances are 106 is higher than the lows, but I still think that the US dollar is confused about what it even wants to do. So at the moment, yes, the bullish action is in. And if you're trading currencies, then you'll want to be looking specifically at things like 104.85-ish, I would say, on the US dollar to see a reaction. Gold, therefore, has also been kind of stuck in the middling zone. No real call outs for this. Of course, longer term, I'm still bullish on gold. I think this is the consolidation we had to have. Weekly looks crappy, as we talked about. Go watch our previous video for some more in-depth discussion on gold and copper, because really nothing much has changed over the last 24 hours. You can still see here copper trying its best. Until it gets above that 20 and a couple of key levels, it's not really breaking out. Now, what about oil? Well, we're bullish on oil, of course, at the moment, and I like to see consolidation like this. Even though it's showing some extreme kind of runs here on the daily, I'd like to see it kind of blitz this area and go up to 84. It has hit some interesting zones, because while this is sitting around this, of course, we like the idea even of it pulling back to 78 now and still being bullish. When we move over to the technicals here on the energy stocks, you'll notice that they've gone down in a very consistent pattern. And this is something I've discussed with our Market Masters Club, which is our private community. If you're interested, you can sign up, free 7-day trial in the links in the description. So basically, this is something I've been discussing, because to me, it looked like we were seeing energy rotation quite a few days ago, and this is starting to really come through. And this coincided very well with oil not actually being off its low, but being off that accumulation area and then breaching. So that was a very interesting point here. And of course, it looks like oil is really trying to put in a good week. And if it can, I think we might be seeing a little bit of sustained rotation into the oil stocks. Could that mean reinflation trades are back? Well, it's something we'll keep an eye on. Tesla, as we mentioned before, pretty crappy daily trade. The weekly was decent. I mean, to close above 180 plus is the first sign of bullish we've seen. So we're still looking for that 200 or just below 200, run 198-ish, 199-ish for Tesla. So still looking at that thing to hold up. And of course, the options market looks completely different to Nvidia now on the charts. Speaking of Nvidia, here's how it closed, right on its closure, down near the lows. It still maintains around that 118, 120 zone. If it fails to hold here, I think it could go all the way to the gap fill, which sits at around 110, just underneath 110. And that may be where it finds a buyer. But to lose this much, this quickly, usually means we're now in a sustained sideways to downward trend for a little while. And I would estimate somewhere between 1 to 3 months. And that would also make sense to some seasonality. Now, effectively, that means that I think it's going to be a lot of dead cat bounces and a lot of, random manipulation of Nvidia. So while the 12 months looks pretty good, the next couple of months may be sideways, and we'll continue to cover that story. Same thing with AVGO, Broadcom, too fast, too quickly, and has to pull back. This stock may be overvalued. I mean, who knows? But the thing is that, that was just a huge ballistic move off the earnings, and it's giving some of that back to get rid of the FOMO. So certainly looking toppy there. Some good markets at the moment. Obviously looking at the Chinese market in particular, you can see here a nice little bullish hammer coming through over the last 24 hours. Still like this level, would like to see it find a new high off that kind of 18.6 zone to really bring in the swing traders. And if we have a look at Tencent, which is probably the most important stock in their market at the moment, you'll notice it's holding its best as well. So that could be good news. Now let's have a look at the Dow Jones. So this was probably the market that I think you had to pay the most attention to over the last 24 hours, as it does have a lot of those financials in it. And I'll just highlight this here. We don't need 2 highlights. And basically you can see that you've got that long leg doji, then it breaches out, finds that extreme strength in it, and that's that rotation coming through. And we already suspected this after we failed to hold these bearish bars. So this point here looked really nasty. Then we find a buyer, rotation starts to play out. It's been days here. This is the sneaky thing, it's the beautiful thing of right price action. And then it starts to rotate through. So I wouldn't be surprised at all for the Dow to overperform some of the other markets, at least some of the sectors to overperform as we see a rotation probably playing out here. Now, NASDAQ, you can see pretty nasty sell-off. Not easy to do the analysis on the NASDAQ as I usually do. I usually look at the S&P, but I think, maybe a little resume, and then ultimately I'd like to see the NASDAQ whip about 1,000 points off it in a proper little correction here that would drive Nvidia down to a better kind of price and kind of give us that standard 5% correction. Now, because we know volatility is coming, things could get even wilder. So definitely subscribe to the channel. We'll continue to play out what we're thinking. But for this stage, yeah, I could see a little bit of relief maybe coming through and then possibly a sell-off. What about the US 2K? I still think it looks terrible on a chart. This weekly is nasty. So, yes, we know that buyers usually commit around this 61.8 fib. Yes, it has got a slight improvement as rotation's going through, but I think it's probably better to pick your mid caps, pick your other large caps and your sectors that are starting to pick up. And the US 2K is filled with unprofitable companies. So as long as this inflation possibility is here, it does hurt the US 2K. And I think we need a 2100 plus to really get that, getting some good momentum. Everything in there is just chopped to me. Now we move over to Bitcoin. Now, I'm not sure if the story is actually as it goes about something like MT Gox. I don't know, people getting back their crypto coins after all these years. But if that's what fell the Bitcoin market, I wouldn't be too worried about that one. It did actually come down to a level that I didn't put in the last video, but I wanted to, which was my first major support. I actually tapped it pretty much perfectly, 58.34. So this is a very important zone for it to hold. If it fails here, 51.7, which you can see here. And then underneath that, we're going all the way down to 42. So I don't know if I expect it, but Bitcoin giving some very poor lower high, lower lows over the last couple of sessions. And as we've many times said, here and here were so important and so imperative to, your success on swing, because it just continuously made lower highs and lower lows. There was just no real quality swing price action to the upside. And it fell straight through. So do I think this is a pretty important level? Yes. Does it have signs of, buy the dip? Well, it has signs of certainly a fear that doesn't seem correct. But it doesn't have that price action that you would usually want from a replicable style trade. So I think it's more the Bitcoin hodlers and position-based traders. With what's going on in Ethereum obviously fell off, kind of giving up a lot of its gains from the ETF announcement. And it's come back to the weekly 20 moving average, the mean reversion, which it's like quite a lot. The 61.8 fib. And you can see here this weekly 20s really held this market up. So very important point. And I think crypto hit two pivotal kind of dip buying zones for a lot of people, although I don't usually suggest that you do that unless you know what you're getting into. All right, let's move over to the news, guys. CPI coming out for the CAD, which will be interesting. Then we've got consumer confidence on Wednesday for, of course, the US. CPI for Australia, be interesting. They're actually expecting that to go up. Maybe we're not as restrictive as we need to be over here in Aussie land. And then the GDP, which usually doesn't do much to the US. The robots can figure that out. And pending home sales, that'll be an interesting one on Friday. And the big one, I think, is really going to be the core PCE. Now, these times might be a little bit off here, I think, in terms of where we're at. But core PCE price index, that's usually one of the gauges the Fed uses. So make sure you're aware of that one, and we'll see how the number ends up printing. If you enjoyed today's video, then remember to subscribe and smash that like button. And in terms of my overall thoughts right now, I think this is the pullback we had to have for semiconductors. It can certainly get a lot worse, and I expect a lot of the rallies here to be kind of DCB style rallies. So I'm not sure we're going to get that V shape back onto new all-time highs and it's going to hold them. I think it's more likely that this is kind of a sustained rally, drop, rally, drop, rally, drop for a little bit as we see rotation. So like always, we've got to practice risk management, and I hope you enjoyed the video. See you in the next one. Thank you so much, guys. Bye for now.